Here's Brent Wilsey's in the studio with us. Wilsey Asset Management. Let's get down to business, Brent.
Yeah.
Sure. No more real estate talk.
No, more real estate. No, let's start making some money here.
Sure.
Can we talk about commodities a little bit?
Sure.
Can you give us a cursor on commodities? I get so many emails about them, and it's so out of my purview.
Right.
Which is why we're talking about gold before, because obviously gold's a commodity.
Right.
But the only
Pork
commodity
bellies and things like that. Is what you're talking about?
but gold and oil are the only two that I ever pay attention to.
Okay.
But there's many more, right?
Well, there's many more. I mean, we can talk about so many commodities. I mean, and generally commodities. The thing about commodities, you own something.
Yeah.
The thing is, what is the price that somebody will pay for? There's no way of valuing. Like a company can look at the earnings and so forth. With a commodity, what's the next person going to pay for that?
Yeah.
So when you look at gold, I tell people, hey, it looks great on your wife, looks great on your girlfriend, but I would not invest in gold because I can't tell you what the next guy's going to pay for it.
Right. But it's never been worth nothing.
Yeah.
That's what I hear in the commercial.
But wait a second. That's interesting you say that, because really that's a great way to explain commodities, because really it just comes down to who's going to mark it up next, or it's a supply and demand issue. It's pure supply and demand.
Right.
You understand what that means, Rusty Nails?
Yeah, I do. Actually, if people want it and you don't have enough of it, they have to pay more for it.
Nailed it. Yeah, that's
right.
right. But that's unpredictable because there's so many market factors that control that stuff.
Yeah. And again, supply demand is so important. And again, that's why with gold and stuff and some of these commodities, I mean, and food. Now, if you want
related, beef and pork are all up this year.
Yeah.
What's going on? Is that because of the drought? Is that because of our mid-America agricultural problem? What does that come from?
It's many different things. And one thing is that the exports are going up, which is good. We're exporting products out of our country, so people buy them and buy our products. But what's really going on with the beef thing is that the price of, because of the droughts over the last couple of years, of grain and corn has gone way up. So farmers say...
to feed them cost you more.
You got it, to feed more. So what do farmers say? Well, my feed costs are going up. I'll have less of a herd, therefore my feed costs will go down. They have less of a herd down the road. What's going to happen is that the price of beef is going to go up because there's not as much of it.
Right.
Now, what is going to happen going forward is going to take about 3 years to get back to normal, because you don't just pop out a full-size cow. It takes about 3 years to grow that full-size cow.
Yes.
No, and on the
this isn't a fast-moving wheel here.
No.
That part of fast food isn't fast.
Yes.
And on the pork's a little more interesting. Pork's about 5% this year. With pork, what's going on is that there's actually a disease out there, I think it's called PEDV. And there's been millions of... have you heard about it?
Oh, yeah. It's the venereal disease of the pig family.
Of the pig, yes. Okay. Right.
Those poor pigs are out there.
Bacon.
I know. They're terrible.
Bacon.
Bacon. So the scary part about that is unlike other investments, and listen, nobody's a fortune teller. We don't know what the future is, but unlike other investments, you really don't know what the future is going to hold with this stuff.
No, you really don't. And here's the thing, too, that with commodities and futures can really get people is that they're leveraged. Sometimes, gosh, I mean, many, many times over. And so you buy a future contract, maybe $1,000, and it leverages maybe $20,000 in pigs. Well, they drop, maybe 20%. You can lose half your money. So you're not just like in a company. I would say don't use margin. Well, with futures and so forth, you can margin a lot higher amounts, and that's why you can wipe out your entire investment.
You're risking. In other words, margining, you can margin 50% against what you're owning. So if you have $100,000 in investments, they'll give you $50,000 to buy more stuff on normal stocks, but on commodities, I think you go up 65, 70% depending on.
I think it's huge. I mean, futures contracts.
Could you imagine?
So you could lose more too.
Well, I mean, you owe that money at that point.
Yeah.
It's collateral against your
like
holdings.
shorting or something somewhere in that family.
Well, I think shorting is actually safer than going on margin.
Yeah.
I was over at. The old Berkshire Hathaway business model, investing, is invest in what you use.
Right.
And if that was my case, I'd be investing in Home Depot right now. But I'll tell you what, that is another company that can be cyclical based upon our GDP.
Right.
Because if people don't have jobs, they can't spend money, they're not improving their homes. But Home Depot.
Or a hurricane.
Driving by Home Depot right now is like driving by Disneyland on a Saturday. Have you noticed that?
Oh, yeah. Everybody goes to Home Depot. It's kind of like the Saturday thing to do. You go in there, everybody's walking around and so forth.
They have the best hot dogs. I don't know why. They just have the greatest hot dogs there.
But what's going on at Home Depot, they just reported earnings. And while they were up 12% year over year, which is phenomenal, they missed the estimate by like 3 cents.
Now, let's talk about why that's important. Because, by the way,
that doesn't matter to me, though.
Yeah, but it does, though. Stock symbol HD, by the way, for Home Depot. And the interesting part about this is if you miss your mark on earnings, if you miss the analyst mark, that is a big no vote of confidence.
Right. Yes.
Talk to us about that.
Sure. What it is that they expect you to do this, they do all this research. Hey, you better hit that mark. If you miss it, you're going to go down. Actually, Home Depot, They actually did go down. They went back up again.
Yeah.
The problem with Home Depot, though, they did great again. Their earnings up 12% year over year. The stock is getting expensive. Right now, they trade around 15 plus times earnings, so you're not getting a great value here.
Okay.
My target sell price based on 16.5 times earnings is around $83, $84 a share. You're at 78 now, so there's not a lot left there.
77. So it's it's a dog without a bone for right now. And I mean, technically speaking, I'm more of a technician than Brett is, and Brett's a fundamental guy, which is why I love talking to him about this stuff, because it's so you can really look at the fundamental side of things, the earnings ledger, who's in the lunchroom, price earnings ratio,
Right.
which you need to, and that's the one leg of the milking stool.
But I'm over here saying they missed their mark by 3
cents.
Yeah, but let me
I'm
tell you
still going to Home Depot to buy my doorknob.
But let me tell you what that does is on a stock like this, it can't get out of its own way. It's below a 13-day moving average. It's barely above a 50-day moving average, and cannot find footing.
Right.
It can, and this is a typical example of a stock where it can't find footing because of the fundamentals.
Right.
And this is a stock where you could actually look at both of those things and actually sort of predict, stay the hell away from it.
Yeah, and you could be holding that stock at between 78 and 80 for the next year, doing nothing at all. You get the 2.5% dividend, but it's not enough. The other thing I found out about Home Depot that I was surprised on, their debt has gone way up. Their debt to equity is 118%. The industry average is 100.
And this is why their relative strength is even. I mean, basically, if you were to look at this stock, this is about where it should be.
Yeah.
Based upon, I mean, at its best.
Right.
I mean, this is as good as it's going to get for a while until they change some fundamentals around.
Right. And that's why I'd say if I wouldn't buy the stock. There's so many other better stocks out there than Home Depot, but they report earnings, big news, and so forth. Everybody goes to Home Depot, so they want to buy it. That's not always a reason to buy a company just because you go there.
It used to be, and I think that's a great example of why not, because there's so many other variables.
Isn't that the old rule of thumb that if you use it, buy it? Like, the quicker picker upper, I'm going to go buy whoever makes that?
Yeah, it did when this whole country was a buy and hold strategy for 50 years. We're not that way anymore.
And I tell people, that's a great place to start, but you don't finish there. You start this saying, hey, great company, a lot of people coming here.
Right.
Let me look and see if they're making money. Let me see if they have too much debt. So it's a great place to start.
That's right.
Don't
mouth breathing like that.
Hey, can I real quick, as long as we're on those type of stores, Brett, I'm going to throw you for a little curveball here, but Target, TGT, lost their CEO. He resigned in the midst of the security breach, and actually he did the right thing. But at the end of the day, the stock on that news dropped from 62 to 56. It can't find footing. It's awfully similar to Home Depot. It's awfully similar to a lot of those same retail sort of stocks. Are these guys loaded with debt now because they thought things were going to be better for them, so they went out and leveraged what they had? Because they're all sort of in the same position on the balance sheets.
What you have to look at, what they did with that money. Did they buy back stock with it? And that's one thing I always got to be a little bit careful with buying back stock and so forth.
Yeah, because when they buy that stock, that's optics for more than anything, right? I mean, they're bringing back a piece of a profit pie by buying their own stock back.
Right.
And they believe in their own company.
Which
that's the optics about it.
Right.
That's the one that makes it. Well, that's the message they want to send.
That's what I'm hearing over here. They must like themselves because they're buying themselves.
But is it really a good thing when they do it? Or are they doing it just for the marketing thing, or are they really getting a good deal on the stock? So that's when you got to look at the fundamentals. What is it trading for on the earnings, the cash flow, the book value? What is their debt load? There's so many things to look at. So I can't give you a good answer off the top of my head.
Yeah.
I would say that could be the start of something good, because if you see a stock drop for that reason, if good fundamentals, maybe then you look at buying.
Stay here for a second. I'm going to keep you over the break for a second because I do want to talk. I want to talk a little bit more about the a little bit of that, because I think it's important for us to dip in and find out why companies buy their stock back. And I think if you really think about it sure seems like a great idea when they must believe in the company. There's so many other reasons.
If they're buying them, I'm going to buy them.
The good news is when you buy your stock back, you take back a piece of the profit pie. The profit pie grows for you. I mean, it's actually exponentially. It could work, but often it doesn't. Big Biz Show, bigbizshow.com. Follow us on Twitter, Big Biz Radio. There's Brett's website, WilseyAssetManagement.com. We come back, more Brent Wilsey, and Riggs Eckelberry will be joining us. Stand by. What are you reading there, Rusty Nails? It looks like a Forbes magazine with a picture of Brent Wilsey in there.
And his fine staff. We should take to lunch sometime, by the way. I'm sure of that.
Oh, yeah. I've seen his staff, by the way.
Forbes magazine?
Can you guys just move in here, Brett? Yeah, for that staff? Yes. It works. Free is a relative term.
Yes.
Good stuff. Brent Wilsey, WilseyAssetManagement.com. Tell us about the article.
Fundamental analysis helps take the emotion out of investing, so you're just a cold-hearted son of a gun, aren't you?
Well, this is what we
look at the numbers here.
We talked about this.
Right.
So I'm a technician.
Yeah.
I look at the charts. I actually look at three things. I look at the chart first.
Yeah.
the technical analysis. Then I look at the fundamentals. Then I listen to the word on the street.
Right.
Brett's a fundamental guy. He digs in, rolls up his sleeves, looks at the balance sheet, looks at everything else. And
that one makes more sense.
Well, it does because I mean, predictive behavior, based on the Elliott wave principle, which happened back at the turn of the century, is great for predicting behavior on. For example, let me just give you a very quick example. You buy a stock at $100. You hope against hope goes down to 80. If that stock goes back to $100 again, what do you think you're going to do?
You get out.
You're going to get out because that's how emotion works, and that's sort of how the predictive motion works. That's not enough though on a long-term retirement plan.
Right.
So that's what that article talks about.
And Forbes, I must say, did a great job. A great magazine did a great job. It's only one of 2 people in California picked for this America's Financial Leaders Award here and so forth. But they did a great job pulling out things about our company and what we do and how important we're kind of like a family for our clients and our customers and so forth. We manage about $150 million in assets, and all our clients feel like they're individualized because we have a great staff, which we are missing one person that picture there, but a great staff that really takes care of people, that they come first. And people say, gosh, where have you been my whole life? Because you guys are so great. You treat us so well. I mean, we have a 24-hour return phone call policy. If you call me today, you're going to return a phone call by tomorrow at 12 o'clock.
What are those calls like? I mean, what are they? Are they in a panic mode when they end up calling you like, oh, dude, I just saw on the news that whatever you invested in just fell out, or no?
It's just like, and we don't get any phone calls because we make people money, which helps a lot. If you make people money, you don't get those phone calls. But it just might be something simple like, hey, I saw this stock in my portfolio, I was wondering what it was, or I noticed this one can pay a dividend.
So you kind of, you take that gobbledygook over here in the money world and bring it down to reality for people who just say, I don't know what you're doing over there, but this looks interesting. And you explain, yes, it is if you're an aggressive investor, or no, it isn't a good place for you because you're an old man and you really shouldn't.
Well, let's talk about that risk-reward ratio.
Sure.
That's all about risk tolerance. How do you tell? I mean, I get that question all the time. How does a guy like Brent Wilsey know how much risk I'm willing to take? What if Brett's safer than I am?
Okay.
What if I'm a cowboy and Brett's safer? Or conversely, what if Brett is too much of a risk taker for
maverick?
me?
Yeah.
So how do you assess that?
And I'm so glad you asked that question because I think the whole financial world is upside down. You go to a doctor, you tell a doctor how to repair you or how to make you better. No, he tells you. He educates you. People come to me, if you're risk adverse and so forth, I want to teach you about how we invest. And I will tell you, out of a 7-year period, we're going to have 2 losing years. That's going to happen. But we can make money by buying good, strong companies. So everybody invests the same way. Now, if you're 90, and we have 4 clients.
Well, let's stop there for a second. Because what he's basically saying is, you might be risk averse, but I'm going to teach you why, based upon my returns and my people that I've had. Look at my client base, look at my tombstone of people I've helped, that why you don't have to worry. Right? So there's not, so it's not a one size fit all, but you're going to melt their fear, or you're going to
eliminate that
talk
choice.
them into reason where they might want to be too aggressive.
The biggest thing that people want is they want to make money. That's what we do.
Yes.
And the biggest problem people have is fear of the unknown. If you can show people that, yes, and we're going to have, and I always tell people, we're going to have losing quarters, losing years, that's going to happen. But look, you own Microsoft. They came out with the new Surface today. Wow, that is fantastic. We have this company. We own Apple Computer. Wow, I love the iPhone. I check the fundamentals, make sure they're a good buy, but you actually own something. So when that stock goes down in price, we now have many clients that they're calling, hey, I want to buy more, I want to buy more. And I say, well, no, we already got 6% of portfolios. Okay, buy more. But it's about owning something. It's about educating people, not saying, oh, you're so conservative. You don't know why you're conservative. We'll
Isn't
teach
there
you.
some little mathematical thing, like if you're 90, 40% of your income should
finish
go,
that one. I won't even let you finish that one.
Big pie that just plug in your information.
Because
but
listen, there are those people that will make you fill out a freaking questionnaire and assess your own risk, which I think it's almost like going into the doctor and saying, what's
wrong with you?
What's wrong with you?
And that's why the whole financial industry is wrong. It's a salesperson industry. They're trying to sell you something. So they want to hear what you want so they can sell you the right thing, not educate you and teach you what you should be doing.
Yeah, you're more of a teacher than an investor.
I had this attorney. He says, you're more of a business evaluator. Buy me good companies at good prices. And he goes, you're different than everybody else.
Business evaluator.
Isn't that good? I like that.
We create a whole business around that.
I just bought the website.
Can I be the president of the company?
Yes, you made it up. Last of all, with respect to that, I always tell people that it is never too late to invest. And one way I do that is by using, there's 100 different retirement calculators out there. There's just that basically just say, look at, let's say you got a 45-year-old guy and blue collar guy's got $25,000 in the bank. Okay. He's probably got 25 years of work ahead of him because obviously 70 is the new retirement age, 70, 75. The guy can only put away $300-400 a month away.
Right.
It's amazing how much money you have with the time value of money after 25 years.
Right.
Though.
Right.
I mean, you don't end up with 100,000. You end up with several 100,000.
Yes.
I think that's probably one of the things people need to understand. It's not too late.
No, it's not too late at all. And the thing is, you've got to make money, and you have to get rid of those emotions because what's going to happen? They're going to get all excited when things are up, and I want to invest, and things goes down. Oh, get me out, get me out. It's like, no, you should be buying now. And again, you've got to look at the fundamentals. You've got to make sure you're buying good prices, but you've got to buy when you don't want to, and you got to sell when you don't want to.
Yeah.
And if you invest properly, that's why it's so important to look at what you're buying and investing properly to make money, not do this whole asset allocation bunk that I call it.
I think I have Franklin Templeton or one of those type of, everyone's there, it seems like. And you look at the 10-year, man, they were up 11, 12, and then you see a couple where they're down 20, 18%, but on the average, I'm up X amount.
Right.
But boy, those down years, if you check every day as someone over here, you do get afraid. Like, oh, should I get out now?
Right.
Is this the bottom? What happened? And they call someone like you maybe to talk you off the cliff or talk you down.
Right. And you know what's so funny is if you were to check the redemptions when that was down 20%, they're very high. And that's why with mutual funds, most people don't match those returns because they don't do what the fund does. That's why, again, I like the individual side because I tell you, you own Microsoft, you own Apple, you own Valero, you own these strong companies. Don't sell those companies. And you actually own something as opposed to like a football team where the players keep changing. You don't have anything, So that's one problem with mutual funds. And also to mutual funds, many times when the prices go down, people start redeeming. Even though you're holding on, you're actually selling a part of your holdings because of that stock being sold at a lower price. So it's all so it's not it's
if someone pees in the pool, there's a little bit going to get on you.
That's right.
I think that's what it comes down to. But I'm going to save your next time you're on with us, which hopefully will be later in the week. We're going to talk about the largest divorce case in history.
Yes.
Because a man must pay over $4.5 billion.
Doesn't make you
so
feel
if you're
good
going
for
through
what we
divorce, you may not have it. We need to talk about divorce planning too, because unwinding a portfolio for divorce is surgical, and although that's not a great thing to talk about, I think it's important to touch on it. Brent Wilsey, Wilsey Asset Management.
All righty.
Thank you, Brett.
You're welcome.